Gold has been absolutely ripping lately, hitting one record high after another. And the big question everyone's asking right now is simple. Is this run about to end in a crash? So in today's video, I want to break this down and give you my perspective. Let's start with where we actually are. This right here is a one-year chart of gold. In 2025 alone, gold is up 64%. Now for some context, the S&P 500, that blue line, is up about 16% over the same period. So yeah, gold didn't just have a good year. It absolutely crushed it, both in absolute terms and relative terms. Now, when you look at this one-year chart, the move looks pretty smooth, right? Honestly, nothing about it screams danger or bubbles just yet. But here's where things get interesting. When you zoom out and look at the 30-year chart, that rise suddenly looks intense. I mean, let's be real, to most people, this looks stretched, overheated, and maybe even fragile. And yeah, in plain English, it feels like gold can't just keep going straight up forever. Now let me zoom out even more. This is the 50-year chart of gold, and this is where history really matters. The most famous gold crash started back in 1980. During the 1970s, gold exploded higher because inflation was out of control, oil prices were surging, geopolitics were messy, and confidence in the US dollar was falling apart. By January 1980, gold peaked around $850 per ounce, and then it dropped about 65%. Now here's the part most people completely misunderstand. Gold doesn't crash just because it gets too expensive. That's not how this works. Gold falls when confidence in fiat currency comes back. That's the key idea. Back in the late 1970s, inflation was running wild. People didn't trust the dollar. Energy prices were exploding. Inflation expectations were baked into the system. Gold reflected that loss of trust, rising steadily all decade, then going parabolic at the end. By the time gold peaked in 1980, the issue wasn't just inflation anymore. It was credibility. Markets didn't believe the Federal Reserve had the guts to actually stop it. And then everything changed. Under Paul Volcker, the Fed did something that's almost unthinkable today. They didn't inch rates higher, they slammed them higher. Interest rates went all the way up to around 20%. Let that sink in for a second. Imagine mortgage rates at 18%. Some of you watching don't even have to imagine, you or your family lived through it. And compare that to today. Right now, under Jerome Powell, the Fed funds rate is about 3.75%. That's not even in the same universe. But here's what really mattered back then. Interest rates were pushed above inflation. Real rates turned positive. For the first time in years, holding cash and short-term treasuries actually paid you in real terms. Saving dollars stopped being a punishment. Capital didn't need to hide in hard assets anymore. At the same time, inflation expectations collapsed. The Fed showed it was willing to tolerate recession, unemployment, and serious pain. Confidence in the dollar came back. Global capital flowed back into dollar-denominated assets. Trust was restored, but at a brutal economic cost. Once that credibility returned, gold's job as monetary insurance faded. So gold didn't fall because it was expensive. Gold fell because it was no longer needed. That's the real lesson from 1980. Now let's talk about 2011. Gold peaked around $1,920 after the financial crisis and massive money printing. Gold surged as insurance against inflation. But inflation never really showed up the way people expected. Globalization, weak wage growth, and excess capacity kept inflation muted. As that became clear, the narrative shifted. By 2013, the Fed started signaling an exit from emergency policy. Real rates moved higher. The dollar strengthened. Stocks recovered. Markets went risk-on. And gold didn't crash overnight, it slowly bled lower. By 2015, it was down about 45%. Same lesson again. Gold didn't fall because it was expensive. It fell because its insurance role wasn't needed anymore. So here's the common thread behind every major gold crash. 1. Real interest rates turn positive and stay there. 2. The dollar enters a sustained strengthening cycle. 3. Confidence in monetary policy is restored. Gold doesn't care about RSI or overbought signals. It responds to real yields and credibility. Now let's talk about today, because this is where comparisons break down. First, real rates are still not meaningfully positive. Yes, rates are higher than zero, but inflation is still eating away at purchasing power. Cash is still losing value in real terms. Second, the US debt changes everything. In 1980, debt to GDP was around 30%. Today, it's over 120%. There's no realistic path to 10%, 15%, or 20% rates without blowing up government finances. Third, deficits are massive. In fiscal 2025 alone, the deficit was about $1.8 trillion. That doesn't exactly inspire long-term confidence in fiat currency. Fourth, central banks are buying gold at record levels. They're diversifying away from the dollar. That baseline demand didn't exist during past peaks. And fifth, the dollar doesn't have a clear long-term bull case as countries continue to de-dollarize. So could gold fall? Of course. But a true structural bear market would require sustained positive real yields, fiscal discipline, a strong dollar, central banks selling gold, and political willingness to accept long-term pain. Ask yourself honestly, do you see that happening? A more realistic view of downside looks like this. 1. Sideways consolidation. Gold chops around for a while. 2. Sharp corrections inside a bull market. A 15% drop would feel painful, but it wouldn't be 1,980 or 2011. 3. A full bear market, which would require policy shifts that just don't align with today's debt and politics. We live in a system built on fiat currency backed by nothing. History shows that every fiat currency eventually returns to its true value. And I'll leave you with this. Gold doesn't fall because it hits new highs. Gold falls when trust in fiat returns, through discipline, real returns, and credible policy. And when you compare today to past gold collapses, the differences aren't subtle. This is for today's video. Thanks for watching. Make sure you like and subscribe. This is Uncle Capital Fox. I'll see you in the next one.